Welcome to the Daily Update Podcast, where I'll go over the action in the market for Monday, November 3rd, and we'll see how things look for Tuesday, November 4th. Going over Monday's market action. The S&P 500 closed up 0.17% at around the 6850 level, a modest gain after a session marked by early strength, followed by a steady drift lower. The index opened above the daily R1 pivot near 6875, printed its intraday high at the open, and then sold off, briefly turning negative before finding support near the 6825 level. It rebounded to Friday's R1 at 6862, only to fade going into the close. This was a near carbon copy of Friday's gap and drift pattern. The futures were strong overnight. We had an opening spike and then sustained selling pressure. Volume was above average, but notably lower than last week's peak. Megacap leadership remained the story. Nvidia was up 2%, Tesla up 2.6%, Amazon surged 4%, all on fresh AI cloud infrastructure announcements. Meanwhile, the broader market lagged, drifting without much conviction. Looking at the technicals, in the short term, the bias still remains positive but trendless. Prices are holding above the 20-day moving average, but the ADX sits below 20, confirming no meaningful trend, and there's been no real test of support yet. In the intermediate term, it's also positive, but warning signs are emerging. The NYSE Summation Index has turned negative, and the McClellan oscillators are continuing to be negative. Long term is still positive. The S&P 500 sits 12.03% above its 200-day simple moving average, a level that has historically invited caution. Gains above 10% often precede larger pullbacks. There's also a confirmed Hindenburg Omen, the second spike now being seen. When we see clusters, this has typically preceded weakness in the past, including 2020, right before the COVID crash, and 2021, before the bear market of 2022. The stochastics remain the only momentum indicator still looking positive, but even that is showing weakness. Growth continues to outperform value in the bigger picture, with the growth-to-value ratio for the mid-caps and small-caps holding up, but for the S&P is lagging. Moving over to sentiment and breadth. Market sentiment improved slightly, now at 44, up from 35, but remains in negative territory. Option flow information tells a different story. There's a bullish call skew, which has surged to 20%, reflecting speculative upside bets using calls. Breadth, however, continues to deteriorate, and new highs are contracting. The advanced decline line is flat on volume but declining on price. The percentage of stocks above their 20, 50, and 100-day moving averages all sit below 50% and continue to fall. The VIX remains below 20, signaling lower fear, and the volatility of the VIX ticked up slightly. Moving over to the fundamentals and macro outlook. Monday saw the ISM manufacturing PMI come in at 48.7, signaling contraction since it's under 50 and missing expectations of a reading of 49.4. In contrast, the S&P Global PMI showed expansion at 52.5. On the Fed front, San Francisco Fed President Mary Daly struck a more dovish tone, remaining open to a December rate cut. Other speakers, including Governor Lisa Cook, emphasized no preset path, which is a less dovish shift from prior messaging. As far as trade developments, the U.S. and China reached a framework deal, 10% tariffs with a 100% hike delayed for 1 year. But the market reaction was muted. This has already been priced in to the markets. Looking at rates and the dollar, the 10-year yield rose to 4.11%, while the dollar continues to advance, and we're watching the 100 level with the U.S. dollar index. A decisive break higher could add pressure to stocks. The valuation story for the S&P and the entire market remains the same, with the S&P forward PE at 23, the Nasdaq 100 at 30, and small and mid caps are more fairly priced between 15 and 16. While profit margins, especially for the megacaps, continue to expand. AI hyperscalers, which include Amazon, Google, Meta, and Microsoft, are ramping up capital expenditures aggressively. Now moving over to the sectors. The top performer on Monday was discretionary, up 0.9%. Tech was up 0.5%, led by megacaps and semiconductors, and the worst performer was communication, down 0.8%. The financials continue to underperform the S&P 500. Now looking ahead to Tuesday, November 4th. Seasonality is strongly bullish. November 4th has been positive since 2002, especially in post-election years. November overall remains one of the strongest months historically. The catalysts in Tuesday's session will include the JOLTS job openings, which is a non-government estimate. The bias in the market right now is mixed, but we default to positive with the ADX still seeing the green line above the red line. What the market needs is one or two strong updates to clear out this recent weakness. Continued drifting risks a normal profit-taking pullback as we continue to be in a non-trending environment. We'll be keeping an eye on any new developments with the Hindenburg Omen, the dollar possibly breaking above 100, and the 10-year yield climbing further. Thank you very much, and I will talk to you in the next podcast.